Hey everybody, welcome back to Investing with Wesley. In today's episode, I want to talk to you about the best possible way people can save that's not an investment. I'm going to talk about money market accounts, CDs, and high yield savings accounts. So with that being said, let's get into it. Now the first account I want to talk to you about today is the high yield savings account. Now the high yield savings account is designed to work exactly like a regular savings account would. This is something you can put your money into, and it is extremely liquid that earns just a little bit of interest. With a high yield savings account similar to a regular savings account, you can withdraw your money free of charge up to a certain amount of times. With most high yield savings accounts and with most regular savings accounts, this number is about 6 times, meaning you could withdraw up to 6 times in 1 month before they even charge you one fee. Now, even though a high yield savings account is designed to work the exact same way as a regular savings account, there is one very key difference that separates the two: the high yield aspect of it. High yield savings accounts usually pay anywhere from 20 to 25 times the average annual savings account rate. Now, as far as regular savings accounts go, the national average interest earned on a regular savings account is 0.04%. But on a high yield savings account, like I said, it is 20 to 25 times higher than the national average. So with a high yield savings account, you can get anywhere from 0.8% to 1% interest on whatever money you deposit in there. So when searching for a high yield savings account, what are some of the things that you need to research to see if this particular high yield savings account you're looking at is the right fit for you? So the first and probably the most important thing is the APY, the annual percentage yield. And this is basically the interest earned on your deposits. These are the 0.04% to 1% that we've been talking about. The next ones are the fees. Does this particular high yield savings account charge you any fees? And if it does, how high are they, and are they charged as a dollar amount or a percentage of whatever you put in there? The next important thing you need to look at when shopping for a high yield savings account is if there is a minimum deposit. And this basically is that there is a minimum dollar amount that you have to give them for this particular bank to start giving you interest collected. And finally, is this high yield savings account FDIC insured? Now, before you go ahead and stress out on all these different numbers, let me just explain to you just how common all these things are. It is extremely common for a high yield savings account to get anywhere from 0.5% all the way to 1%. So when it comes to the APY, the annual percentage yield, all you're really looking for is the biggest number possible so that you can get as much interest possible. As far as the fees, deposit, and FDIC insurance goes, this is actually extremely common with pretty much any high yield savings accounts that you're going to look at. For the most part, any high yield savings account charges 0 fees. There are a couple online that do charge very small fees, but this is because they give you even more interest than all the other high yield savings accounts go. But in my opinion, paying a fee just to have a little bit more interest is not worth it. As far as minimum deposits go, typically I see a bunch of zeros where no minimum deposit is required, but the max minimum deposit I've ever seen on a high yield savings account is only $100. So if you were actually going to treat this like a real savings account, you could probably meet that $100 threshold with no issue. And as far as the FDIC insurance goes, any real bank offering you a real high yield savings account will be FDIC insured. If this high yield savings account that you're looking at is not FDIC insured, then it's likely there's some sort of issue or scam going on and you should run for the hills. Now, just to save you the time and headache, I've already done the research on the 2 best high yield savings accounts in my opinion that if you were going to open one up, you should put your money in. The first one is American Express Personal Savings. This high yield savings account is FDIC insured, has 0 minimum deposit, 0 fees, and earns you a 0.4% interest. The other high yield savings account that I think is the next best is Marcus by Goldman Sachs. This is a high yield savings account that again is FDIC insured, has 0 fees and 0 minimum deposits, and actually pays you just a little bit more interest than the American Express Personal Savings one. Marcus by Goldman Sachs pays you 0.5% interest. Now you'll notice that I actually think Marcus is second best compared to American Express, and this is because although right now they pay more interest than American Express does, historically I've always seen greater returns from the American Express Personal Savings than we have with Marcus by Goldman Sachs. So if you're going to open up this high yield savings account for the long haul and store all your available cash in this, then I would actually prefer you going with the American Express, because although you'll be taking a 0.1% loss right now compared to the Marcus by Goldman Sachs, In the long run, you'll actually receive more interest as the feds raise rates in the future, and all the other high yield savings accounts out there will also raise the amount of interest they give you because the federal fund rate has raised their interest as well. This actually leads to my final point with the high yield savings account, and that high yield savings accounts are actually on a variable interest scale. And as the Federal Reserve's interest rate goes up and down, the Fed funds rate, so does the interest rate that the banks and saving institutions will give you to deposit your money with them. A good example was before the Feds cut rates in 2020 due to the pandemic, the American Express personal savings account I had was getting a 1.85% APY. Whereas Marcus by Goldman Sachs was only getting 1.6%. But when the pandemic hit and the markets crashed down and the Federal Reserve lowered their interest rate, that lowered the APY on all high yield savings accounts with it. Now, the next type of account that people use for saving their cash is a money market account. Now, although historically money market accounts are way more popular than high yield savings accounts, lately, with just how easy it is for robo-advisors to create these accounts, high-yield savings accounts have actually become way more popular in recent years. But the reason money market accounts are still in the running is because money market accounts actually have the potential to earn more than a high-yield savings account does. Now, money market accounts are very similar to high-yield savings accounts in that both of them provide an increased amount of interest on all your deposits. But like I just mentioned, money market accounts actually have the potential to give you more interest than high yield savings accounts. Now, although if you do your research, you'll see that the APY on a high yield savings account and the APY on a money market account are practically identical. But there's one key aspect that makes a money market account different, and it's also the reason they can get greater returns than a high yield savings account can. And this is because a money market account is allowed to invest in CDs, commercial paper, and government securities. Now, when it comes to high yield savings accounts, these accounts can't invest in all those things I just mentioned. Only a money market account can. So in the low interest rate environments like we currently are in, money market accounts and high yield savings accounts are basically identical. But once interest rates start going back up and we enter another time where high interest rates are prevalent like we had in the 1980s, money market accounts vastly outpace high yield savings accounts because of all those things that they're allowed to invest in. Now, some of the best money market accounts I've seen out there, just so you don't have to do the research yourself, is the Brio Direct money market account, which gives you 0.6% interest currently and only has a $100 minimum deposit. The money market account that's next best is the CMG Community Bank money market account. This money market account pays you a 0.52% interest annually, and unfortunately it has a little high of a minimum balance, and that is you have to deposit at least $1,000 in this account when you open it up. I know all the numbers I'm telling you right now might mean absolutely nothing to you right now because they're all less than 1%. But I want to reiterate the fact that even with the high yield savings account or the money market account, or even the next account we're going to talk about, which is a certified deposit, that all these accounts are getting less than 1% because the federal funds rate is so low. As interest rates go back up, so will the interest you earn on all of these accounts. A good example was in the 1980s when interest rates were extremely high for the Federal Reserve. Money market accounts were getting about 13% interest annually, whereas savings accounts were getting about 8 or 9% interest annually. Nowadays, as unfortunate as it sounds, the only way you're getting those high of numbers when it comes to interest is investing in either junk bonds or equities, meaning stocks. Imagine being back in the 80s where you could put your money as a retirement account in a money market account getting 13%, and it's guaranteed because it is a money market account guaranteed by the bank. It's safe to say that saving for retirement and saving for the future back then was a lot easier than it is today. But it's safe to say that interest rates can't keep going down forever, and at some point something has to change to cause interest rates to go back up. Now, what would cause this change is a topic for a different video, but everything has its own season. In the 80s, we had an extremely high interest rate phase, and in recent history, the interest earned just keeps going down. So if you're planning for the long haul, or if you're under the assumption that something's going to happen and the economy is going to come back and interest rates are going to come back with it, then keep these in mind because this is a way to capitalize on all those returns when the interest rates inevitably go back up. Okay, the last saving instrument that I want to talk about today is a certificate of deposit, otherwise known as a CD. And something like a CD you can get at any bank, credit union, or financial institution. They are extremely common. And although they provide the same amount of interest rate that a high yield savings account or a money market can provide, there are some huge differences to a CD versus those other two options. First of all, a CD is not liquid like the other two. In the other two, you could deposit your money, a family emergency happens, and you could withdraw your money within the same day or two. They work exactly like a savings account, and they're designed to be extremely liquid. However, a certificate of deposit is different. A certificate of deposit basically is you making a deal with the bank saying, I will give you X amount of money and I will not touch it for a certain amount of time. And in that time frame, you can do whatever you want with that money, but pay me interest in the meantime. So a real world example of this is that I give Chase Bank $1,000 for them to hold on to it for 15 months. Now, during the course of those 15 months, they're gonna pay me 0.6% interest annually. Once those 15 months are up, I'm able to withdraw my money and my profits, or reinvest my money with those profits for another 15 months or another term and get even more interest. Now, if a family emergency were to happen and I needed to withdraw from that CD, you actually have to pay a penalty. This is why I said it is not liquid, because it is designed to trap your money in this account for a certain amount of time. Now, historically, CDs have always paid more interest than money market accounts or high yield savings accounts. But again, interest rates are so low that pretty much all three of these options, you're getting the same amount of interest across the board. Just like a money market account excels when interest rates are high, so do CDs. When interest rates are low, they're pretty much all the same. But when interest rates are high, CDs actually give you even more interest than a money market account would. And the reason these kinds of things happen when interest rates are high is because the banks need money all the time to lend it so they can generate a profit. If the federal funds rate is high, meaning it is more expensive for a bank to borrow money from the Federal Reserve, then they use the CDs to generate and borrow money from their customers. So just as an example, if the federal funds rate went all the way up to 10%, banks would start issuing CDs at about 9%. Because even though they have to pay you that 9%, it's still that 1% cheaper than going with the Federal Reserve. This is why back in the 1980s, we saw CDs, money market accounts, and high yield savings accounts with such high interest rate numbers, is because it was extremely expensive for them to borrow money from the Federal Reserve. So they incentivized their customers to lend the banks their hard-earned money so that they can receive a healthy amount of interest in return. Now, currently when it comes to certificate of deposits, the two best ones I've been able to find is, again, Marcus by Goldman Sachs. They also offer a CD. This particular CD has a 9-month term, and in that 9 months, you'll receive 0.65% on your interest. The downside is there is a $500 minimum deposit on this CD. So you have to at least give them $500 to even make this entire thing work in general. The next best CD I found is by Rising Bank. Now, Rising Bank offers you a 15-month term where they're gonna pay you 0.6% interest, but the minimum deposit is pretty high. The minimum deposit is at least $1,000, meaning you have to give them at least $1,000 for them to even be able to open up your account. But why does any of this matter? Why should you open up a high yield savings account, money market account, or keep your money in a CD? And the answer is as simple as this. Not all of your money that you have should be inside an investment. In today's market, you're gonna see way better returns investing as opposed to savings. But not all of your money should be invested. You should have savings for things like an emergency fund or cash reserves so you could capitalize on a downed market, anything like that. So the important thing is, where should you keep those cash reserves? Where should you keep your emergency fund, or where should you keep your excess cash so you can invest when markets take a dive? This is the importance of understanding high yield savings accounts, money market accounts, CDs, and all these other saving vehicles out there. It's not only important to pick which of these three is best for you, but whichever one is best for you, to pick the best one of that. To pick the absolute best high yield savings account or the absolute best money market account so you can get as much interest as possible, even though currently it's going to be less than 1%. I hope you got value from this video. If you did, please remember to like and subscribe because it really helps the YouTube algorithm and get this channel out there. I also have a dedicated Instagram account, so if you ever have any comments or a question you might want answered, feel free to follow me and reach out to me there, because it's a lot easier to answer a private question through the Instagram messaging app than it is to reply to everyone's different comment threads here on YouTube. But until next time, have a good one.